Good evening, ladies and gentlemen. Envy here, G7FX. Thanks for locking in to the first video on the channel. Given it's the first video, no one's going to be winning any Oscars here, but hopefully I'll be able to deliver some useful information. In fact, what I believe to be the most useful statistic used by all professional traders. Don't see it discussed here at all. I could be mistaken. I'm sure some of you are looking at it, but if you're not, you should be, because I don't know how you're setting your stop losses without this information. Just before I get on to it, the video will be no more than 2-3 minutes, but I just wanted to address why I'm wearing this ridiculous mask. I've been asking myself the same question, but in all seriousness, as you may well be aware, I'm a former FCA registered advisor to some of the biggest central banks and hedge funds in the world, and I, for obvious reasons, decided to take the short-term decision not to reveal my face, but I may change that in the future. Many other reasons I decided as well, but I'll address those in the future. In the interest of keeping the video short, obviously today I know is a US bank holiday. I did have quite a bit of trading myself, given, as you've probably guessed from the accent, I'm in London, UK, so today was a pretty stellar day, up 1.5%, which I will cover later with some of those exciting order flow setups everyone seems to be loving. But coming back to the statistic, there's MAE and MFE. To keep the video short, I'm just going to cover one of them, which I think is the most important one, and then we'll come back to the other one later. It's called MAE versus MFE. Now, if I just minimize myself here and maximize the screen so you can really zoom into this number. Essentially, the reason why this statistic is so important is because I have no idea how anyone is setting their stop loss without it. Now, all I hear is set your stop loss behind the swing low, swing high. It's all complete and utter rubbish. I'm sorry to say, but it is utter rubbish. Every market maker knows those areas. They're going to be hunting those for liquidity. So the last thing you want to do is place your stop losses in those areas. You also don't want to be setting your stop loss according to risk reward, because it is completely arbitrary. It's random. And to get ahead in this game, you can't be doing random things, of course. It's a serious business. But without much further ado, if we look at what is this statistic telling us, well, MAE is maximum adverse excursion. So what does that mean? That means if you're in a trade, for example, you got long here, it's how much has the trade moved against you before you closed it out. So you may close it here, you may close it here, you may even close it here. It doesn't matter. That is your MAE. The most the position went against you before you closed it out, also known in simple terms as drawdown. Now, why is this so crucial? Because if you actually look at, everyone seems to be obsessed with single trades. Again, ridiculous. You're going to be taking many trades in the month, and that is where you're going to get vital free information. You're essentially being told by the market in terms of a sample, really. So there's your sample of trades. How much has a trade gone against you versus how much profits you're making. Now, you want this line to be pretty solid. What you don't want is outliers all over the place, and I'm going to quickly explain why. So if you can get access to something simple like my FX book, and I will be going through this in much more detail in longer videos, but if you can get access to things like my FX book or TraderView, then you can have a look at your statistics. I'd urge you to do that. But essentially what this is saying is, for example, I've got a bunch of trades here. What this is telling me is that typically when the market goes 20 points against me, I'm out. I don't want to be in those trades. Why is that? Well, I know from this market feedback here that essentially when a trade goes significantly in my favor, look how much drawdown I'm taking. Nothing. That doesn't make me a hero, but all that is it's telling me in my style of trading that if the market goes more than 10-15 pips against me, I want to be out of that trade. So that's what I do here. So no coincidence that you see my outcome 10, 15 pips. When I get big drawdown, I'm out. I don't need to be in the trade. So that's A. And then in terms of setting the stop loss, well, it's common sense really, right? When you look at this, sort of the final quartile of my data is down here. Majority of my trades are there. Why on earth would I have a stop loss bigger than, say, 30 pips? So in my mind, mentally, when I'm taking drawdown, I know, not because of a swing high, swing low, support and resistance, trend line, band, or whatever nonsense, I know because of my trade statistics that I should not be taking heat on any trade more than 30 points. Now coming back to the outliers, why don't I want outliers? Now imagine you've got outliers down here. You may even have an outlier down here. That means you're taking 50, 60, 70 points of heat to make what, 15 points. One day what's going to happen, if your stop losses are too big, is you're going to take such big losses, it's going to wipe these out in one go. I see it time and time again, not only in retail, obviously also happens with ill-disciplined institutional traders as well, where they're so desperate to hold on to trades. All it takes is 1 or 2 or 3 to wipe out a whole portfolio, so you don't do it. So that's why your line in the sand goes there, and you know your stop loss should never be bigger than that. Simple maths. Hope that was useful. Again, it is a complicated topic, but anyone can get started on it. Have a look at this number. If you've got any questions, let me know. Thanks for watching.